In this video, we're talking about the Apple stock split. Now, it's already split, and it's already moving higher. I have an opinion on where the stock's trading now, and would I buy it? If I did buy it, what would I do? But I have another idea, and I'm also going to give you a word of warning looking at that chart. Now, stick around, because I know you're going to like this one.
Let me show you my eyes.
Hey, welcome back, everyone. It is time for another red-hot covered call video. Well, hey, look, today we're going to talk about Apple. Apple's stock has split. What do we do now? That's what we're going to talk about. If you remember, it wasn't but about a week and a half ago, I did a video on the Apple split and how we can benefit by writing covered calls, selling cash secure puts, depending on how you wanted to play it. You know, a lot of people could not get into Apple stock when it was trading for some $400 and $500. So now with the stock splitting, it becomes in play for a lot of us selling premium players. And I'm going to show you today how we can play it, because now it becomes a stock that we can use. But with that said, we have to make sure we're doing it right. And in this video, I'm going to show you what I think and where we're at right now with Apple stock. Now, hey, look, if you like what you're hearing today and you want to be a part of it, I want you to subscribe to the channel. It's right there and it's free. And hey, look, if you like this video today, bang that like button. It lets me know you like what I'm doing. Now, what I'm doing is we're going to the Apple chart, and as you can see, it is rallying today when the stock market is actually falling. Now, the one thing that I want to make sure if I'm an investor that wants to be a part of Apple right now, you know, I've been chomping at the bit to get some shares of Apple so I can sell premium against it. I mean, Apple checks all the boxes for a great covered call stock. I mean, it's the biggest stock on the planet. Institutional investing is everywhere. There are analysts that will come out and defend the stock if there's a shred of bad news. And Apple has some $300 billion in revenue. I mean, this is the big of the bigs, okay? There's 5 stocks that are driving this stock market right now, and Apple is the biggest of them all. So with it splitting, it becomes in play for all of us covered call writers, right? Because now to own 100 shares, all we have to do is pony up $12,900 and we can get in the game. So we can still be diversified in our portfolios, right? Because when it was trading for $400 and $500, you had to pony up 50 G's just to own 100 shares. So now we can start trading Apple. And as you'll see with their premiums, they pay some juicy premiums. We can actually double what we typically like to make writing covered calls per month with a stock like Apple. But hold on now, pump the brakes, because if there's anything you know about me, if you've been watching my channel, is this: we try to adhere to the golden rules of covered call writing and the golden rules of investing. Now, a part of the golden rules of investing is trying to get a low entry purchase. So we have to ask ourselves, right? We're giddy. We want to get into Apple. Man, we're ready to rock and roll. But before we go there, we have to look at the chart. We have to look at our indicators, okay? For me, it's quite simple. I have about 4 or 5 chart indicators, all right? I want a low entry purchase. That's where we're going to start today. I want a low entry purchase on any stock that I'm getting involved in. And just because Apple split doesn't mean I'm going to not adhere to those rules. Now, if you've been following my channel, you know I absolutely love the Keltner channel. Now, the reason for the Keltner channel here is it's a stock's predictable trading range. Now, I've told you the story many times. Chuck Hughes loves the Keltner channels because it is a predictable trading range. Every time a stock falls below its Keltner channel mid, we start to dip in that area where Wall Street starts to notice it. Okay, now this isn't bankable for every stock, but the ones that I watch, I'm going to set that rule that I want to buy the stock at least under the Keltner channel mid, because then I start to feel like I'm getting a low entry purchase. Because remember, when we write covered calls, what we'd love to do is buy that stock at a low and we sell the out of the money strike. So we get both the premium and the stock appreciation. So if we're buying low, we avoid risk. Now, what's that risk? The risk is if I'm buying at the high and I write the covered call and this thing tanks, well, guess what? I'm owning the stock, which means I'm owning the risk. Now, you're hoping that this is 1 point or 2 points and not 10 points. Okay? So what we're looking to do is always have the low entry purchase. In the case of Apple, I mean, right off the bat, you can see this thing is not only trading above the Keltner channel mid, it is absolutely trading above the Keltner channel top. That first indicator just throws up a red flag for me. Now, again, it's not a deal breaker, but I'm going to tell you now, man, I'm not looking to shift it into overdrive. I'm downshifting, if you know what I'm saying. So now I have to have another indicator. What's another indicator to paint this picture for me, to tell this story for me? Well, I love using the RSI. The RSI is an indicator of overbought or oversold. And when we get into the 80s, okay, if the RSI is in the 80s, that is a clear overbought indicator. I'm not even an expert at charting and technical charting, but I know one thing. When you get into the 80s with your RSI, Wall Street sees that as an overbought signal. So they might take profits. They might be more likely to take profits versus jumping in feet first, right? So for me, that's another red flag right here. Now, again, I'm not saying that I don't want to own Apple, but do I want to own it right now? And by the way, it's up some 4% on all of this buying. Think of it this way. When we go into the close of Friday, all these people that want to own Apple start to put in limit orders. They're putting in limit orders over the weekend to buy Apple when it opens up on Monday. It's going to open up on Monday, split 4 for 1. So all those limit orders come in and they start getting filled, pushing Apple higher. Now, you have to understand how Wall Street works. A stock moves up or down based on supply and demand. Now, its stock may be higher based on that early demand for the stock. But if there's no sellers, market makers aren't necessarily going to push the price down. So the question now is, are we getting in to Apple a little frothy here? Well, this is what I see. I do see it being at a high. I do see it as a possible opportunity to wait, pump the brakes and wait. Now, with that said, I could be wrong. I've been wrong on Apple the whole time as it's gone to high and high and high. Look, this thing is worth $2.1 trillion. So right on the face of it, this thing has to be perfect. And a lot of people would agree that it is perfect. Apple has its detractors, but I'll tell you what, man, it has its supporters, and they will support this thing. So for the most part, Apple's going to trade in a range. You know, they'll sell it off, they'll buy it back, they'll sell it off, buy it back. Now the question is, for us small ball traders, retail traders, what's a good time to buy? Well, this is what I'm going to do. I'm going to go ahead and instead of buying Apple here or putting in a limit order to buy Apple at a lower price, because when I look at Apple right here, I mean, I'm thinking not 129. I mean, I want to own Apple at 110. Now, do I think it'll get to 110? I'm not sure, but the support lines tell me 110 could be a good entry point. Well, instead of buying the shares now, taking on all that fluff risk that I actually think's in the stock right now, I'm going to sell a cash secure put. I'm going to go ahead and put the money up right now for a 110 strike. And what they're going to do, somebody cannot lose more than $110. Now, that is very possible that people are interested in the 110 strike. That's support. They can't lose any more than 110. So they'll find a guy like me that is put up $11,000, right, for a time frame, and they'll buy that insurance. They'll buy the right to assign me their shares at 110. So they can't lose any more than 110. Well, what I do is I put up that money and I agree to buy somebody's shares at 110. Now they're going to pay me a per share premium for that because my money is going to be up for the time frame that I pick. Now I usually pick a 30-day time frame. So if Apple rallies because of this initial buying of all these people that want to get in to a stock split Apple, well, as that buying pressure decelerates, this thing's going to start to move down as market makers have to adjust the price to get more buyers. Well, here's the deal. This thing could easily come back to 110. Now, I'm going to get the shares at 110, and I'm going to collect that premium for which I put up the money. And I'm going to go to the options here and see what that would pay me. But first, I'm going to show you, if you were to buy Apple stock right now at 128.80, what kind of 30-day premium you would get. Now, notice I picked the 30-day October 2nd covered call here. So notice that Apple is trading right now at about 28.80. So if you bought the shares and you wanted to write a covered call at the money right now, collect no stock appreciation for the next 30 days, somebody will pay you $7.70 for that. Okay. And that's going to turn out to be a nice covered call trade. You could elect to sell the 32.50 and get $6 for that. And that's going to turn out to be an even more cash on cash trade. So it's one of those stocks that's going to have great premiums, and you're going to be able to buy a great company, and you're going to be able to sell premium. 100 shares at the money right now will put $770 in your wallet, and you don't have to do nothing. You can write that out of the money strike for $132.50 and get $6 or $600 in your wallet right now. And if the stock goes above $132.50, they're going to pay you $13,250. So selling premium is one of those things that just keeps on giving. If you buy the stock here at 128.80, you sell this 30-day covered call. Think of it this way. You have downside protection, right? You have a little bit of downside protection if you elect to use that, because look, they're going to pay you $7.70. So you bought the stock at 128.80. If the stock were to fall because all of this buying sort of dries up over the next couple of days or the next couple of weeks, they paid you $7.70 literally to hold on to the stock. And as it falls, if it were to fall, you have $7.70 of downside protection, or now a 121x cost basis, right? You paid 128.80, they paid you $7.70. What's your true cost basis? It's not 128.80 anymore. Now, with that said, if you're me and you don't want to buy the stock right now, let's take a look at a cash secure put. Now I'm looking at the October 2nd cash secure put action. As you can see, it doesn't even really go to 110. It goes to 116. So using 116, you can see if I put up enough money, $11,600 to buy somebody's shares, okay, for 30 days, they will pay me $2.67 per share up front. Now, there's not much volume or open interest there, so I may not use that strike. But if I wanted to, I could. And for $11,600 being put on the bench, giving this person the ability to give me those shares at that price, they're going to pay me damn near $3, right? And for 30 days, that's almost 3%. I will take that because that fits our wheelhouse 3% cash on cash percentage gain every single month. If I'm assigned the shares, guess what I can do? At 116, I can write a 30-day covered call and expect to collect about $7. So as you consider what you're going to do today, you have a lot of options. I mean, Apple's one of those great stocks that for the most part, can't go wrong with. I would say this, buying right now, you're buying more in the fluff zone versus the low entry purchase zone. I don't even know if we ever get to the low entry purchase zone unless we have an overall stock market correction. And that could happen. I mean, hey, Wall Street takes its profits and they take it in pennies. So this could happen any day. So for me, I'm going to look at it this way. If I want to own the shares and I think the stock's a little bit pricey right now, it's a little rich in its valuation, I might do the cash secure put, get paid, sit on the sidelines, and if I'm assigned the shares, then that's okay. We'll work from there. If I went ahead and bought shares, well, I'm not going to sit on my hands. We are going to jump into action. I'm going to look at that 30-day covered call. We're going to look to pick up that 6 to 7% that we can make on Apple shares. And that's just how I see it. Okay. I am a buy and hold investor, but when I put money towards my selling premium portion of my portfolio, those shares do not sit on the bench. I always got them working. Hey, look, if you enjoyed this video, I want you to subscribe to the channel. It's right there and it's free. Bang that like button. It lets me know you like what I'm doing. And what I want you to do is go over to Facebook, because that's where I'm updating everyone on my stock purchases. Be safe, be healthy. More important, be lucky. Until next time, may all your covered calls be profitable.